Hey there, OptionX students. Tom Gentile here with you. Today I wanted to put together a special video because of what's happening in the world here as we end out the month of January. So this video I'm calling Trading World Events. All right, so Trading World Events. So let's talk about it. Let me just show you a couple of charts of the market right now. And so I pulled these off of tomsoptiontools.com. Feel free to check us out if you haven't tried this. We've got, I like to call it world-winning, all right, award-winning options software. So check it out, guys, www.tomsoptiontools.com. S&P 500, all right, so we had a drop earlier in the week. In fact, the Dow was down over 500 points, all right? We're going into, by the way, this week is supposed to be the biggest earnings week of the quarter. This is the sweet spot. This is where most companies report earnings. However, we've had some issues that have put earnings on the back burner. Take a look at bonds. The bond market this week gapped up as stocks gapped down. And oil, all right, a commodity that I look at quite a bit to help me gauge what's going on in the overall economy, gapped down and is now threatening to take out the lows that occurred back in October of last year. So what world event are we talking about? Well, we're talking about the coronavirus, all right? With earnings in full swing, typically that's what we concentrate on as traders, earnings reports in individual companies. But the coronavirus is now pushing earnings to play second fiddle. All right. How do you trade an event like this? Well, think of this event as any world crisis event or any event that would shock the markets and spike us 500 points one way or another. Most of the time, the 500-point move on the Dow is not going to be up. It's going to be down. And I'm talking about gaps, where it happens overnight. You wake up in the morning, you're taking a look at financial television, and you see, oh my gosh, the markets are down 500 points. All right. So 3 steps I want to talk about in trading through a world crisis. Step 1, let's just take less risk in your current strategies. Step 2, look at what's going up in a down market. And step 3, exploiting volatility. Let's take a look at each of these for a moment and, kind of push them out a little bit more. Step 1, taking on less risk. Risk is, this is probably what a lot of people think of as the most boring part of trading. However, it's the most important part if you intend on making trading more than just a short hobby. Taking on less risk. It could be simple as cutting your trade sizes in half. So if you're used to trading 10 contracts at a time as an option trader, maybe you drop to 5. If you're used to trading 200 shares of stock on average as a stock trader, maybe you cut down to 100 shares of stock. All right, as we came into 2020, I like to do the dogs of the Dow. I like to do various strategies on the dogs of the Dow, but because of the up run, I like to call it like the melt up in the markets. All right, I took on a big position, but it was half of what I would typically take on because of the fact that we had that melt up and volatility was creeping up. Now, volatility's come up quite a bit here in the last couple days with the coronavirus. And the simple thing you could do is just cut your trade sizes in half. A more complex idea would be to take a look at the VIX or the VXX and use it as a risk barometer. The higher this thing trades, the more volatility is in the marketplace, the less contracts that I need to trade in order to get the same result. Okay? And number 3 on taking less risk would be maybe cut your profits and losses down. All right? Cut your profits. Take profits quicker. Take losses quicker. All right. Step 2, we talked about looking at what is going up in a down market. So I went to Tom's Option Tools and I clicked on something called Market Overview. And what I'm looking at here was I was looking at roughly 560 stocks. What did they all have in common? They were either they traded weekly options or they were part of the Penny Pilot program, right? So 560 roughly. And of the 560, I was looking at 63 stocks on the morning that the market was down 500 points were up. That meant that almost 500 of my stocks were down, which told me that 10% of the stock market was going up on a down day. And I looked at these stocks and I went, okay, well, that's a short, that's an ultra short. Those are always going to go down if they're market related. They're always going to go up when the market goes down. CME and CBOE were on the list. I think because there was going to be excessive trading on this day that it was going to push exchanges to go higher. But I want you to take a look at a couple of others. Clorox was on this list. All right. Definitely coronavirus related that Clorox was up on the day the market dropped. TLT was up. That's the bond market. On the day the market was up. And then UXVY and VXX, those are volatility indices, and volatility is going to go up when the markets go down. But I want to share with you a couple of other ones that I saw. Look at all of these starting with GLD. GLD gold, all right? JNUG, gold. Nugget, gold. Kinross, gold. And it just Newmont Mining, gold. Goldcorp, gold. I mean, they're all over the place. GDX, GDXJ. A lot of gold, which means that gold tends to go higher during potential crises. All right. Also, I noticed natural gas went higher too. Natural gas typically is I find that interesting. UNG and natural gas tends to go up when the oil markets gap down. So it's kind of a flight to a quality energy. All right. So looking at stocks and looking at indices that go higher when the market goes lower, and so that's an idea. And then finally, exploiting volatility, and this is something we as option traders do. So if you look at that chart to the right, that's a risk of a stock, all right? It's hard to exploit volatility when you're just trading stocks, all right? But the way that we exploit volatility is trading options. So if volatility goes higher during down markets, that means most options are going to be more expensive. They're going to get more expensive. So to be on the right side of probability, consider selling options premium. And I would like to say with protection, such as credit spreads, instead of buying. All right? So, what do we do over here at OptionX and Tom's Option Tools? Well, you guys know what we do. We are rules-based traders. We look at step 1, spotting rules-based opportunities. Okay? Step 2, creating low-risk and or high-probability trades. And then, of course, step 3, planning, executing, and managing these trades. I hope this short video was of help to you, so that when the next world crisis comes along, or if this one continues, you're able to at least have some ideas and a bullet plan on how to minimize risk and maximize reward. Thanks, everyone. Have a great day. Bye now.